Alright guys, I'm back with another video now. Before I go any further, not a financial advisor. Obviously I own Gamestop, so I'm biased, so please take that with a grain of salt. And also, I'm not the expert on analyzing company. I'm just learning as I go. My education is that I get is from Googling things. Okay, so if you want to evaluate it the right way, find a professional to do it. So let's get started. So in this one is going to be a comparison between GameStop and Apple, right? Now I realize that this company are two different companies from two different industries, so please keep in mind I'm comparing apple to orange here, okay? But there are metrics out there that you could compare between company, whether this company is undervalued or overvalued, and those are price to earning, price to sell, and all that stuff, right? Any metric that kind of take the balance sheet and compare the market capitalization and what is it's earning, in compared to them. So if you take these two companies, you could kind of compare which one is undervalued and which one is overvalued. Now the first thing that I want to show you is this right here that I kind of like notice every single time. Like every time they want you to buy into something, it's this. So look at the inside ownership of GameStop. It's close to 13%. Okay. Now, this is the company that they want you to sell, okay? Meaning that, this is a terrible company. Do not invest in it, okay? This is the analysts out there. You know who. Just give me a minute, 1 second, okay? All right, sorry, I'm back. So, with Apple, though, they want you to buy into it, right? And they give high price target to this particular company. But look at the inside ownership. Less than 1%. This is alarming to me because these executive does not care about what happened to the stock price, or they know that the stock price will dump at some point because they cannot grow any further. It's overvalued. It's way overvalued because eventually the earning is not going to justify what they're doing. All right. So for the evaluation or valuation ratio, we've learned this one before, and what it is taking price to earnings ratio and forward ratio. Forward ratio is just it's an expectation for the next year versus the actual P ratio. Sorry about that. So since GameStop is in the negative still, now we knew that last quarter, they only lost $2.8 million for that 3 months. But if you do the trailing 12, they lost over just under $100 million. Now they have 2 more quarters to go, so I just cut them some slack here, okay? So that's that. Now, if you look at the PE ratio for Apple, though, it's close to 30. $28, 28 times. So if you look at what is a good PE ratio here, says that a low PE ratio means a better investment, okay? But it could be misleading and it could be manipulated. But in the rule of thumb, though, if you look over here, below 10 is best. Okay, below 10 is good for value investing. But again, it's industry. Each industry has its own standard of cheapness. Okay, we've read that before. Now, it just means that, hey, maybe people evaluate this company as higher value because people are willing to pay it for more because, they sell expensive stuff and they have the monopoly over the market, allegedly. But it's it's big enough that it's not going to go anywhere, so more people want to invest in it, therefore more expensive, okay? But as far as this go, it's overvalued because it's over 10. The same thing with the forward PE ratio. Now, if you look at the price to sell ratio for GameStop, it's less than 1. This is an excellent position to be in. You look at, according to Google, anything between 1 to 2 is good, while less than 1 is excellent. Okay, so less than 1 is excellent. What does GameStop has? Excellent ratio. What does Apple have? Overvalue. More than 2. Okay, so who's the winner here? Same thing with PE ratio. Forward PE ratio for GameStop is less than 1. But if you look at the definition right here, oh, this is price to, that's a book value. What's the forward one? Okay, sorry. Apologize for that. I thought I had it open. All right, so a low PS ratio indicate that it is undervalued. So GameStop is undervalued. But if you look at the forward right here, PS ratios of less than 0.75 is extremely desirable. Okay. But for equity, I think GameStop is qualified to be equity. Anything between this number right here, 0.75 to 1.5, is considered to be a strong buy. So that's what GameStop has, okay? All right. So, but if you look at Apple, forward price to sell ratio is bonkered, right? And this is probably why the executive all sold their share, because they know at some point it's gonna catch up to its earning. Okay, it's not gonna justify it anymore. And price to book, obviously it went down. It used to be 4, which is good. The lower, the better. Anything close to 3 is considered to be a good value investing. But if you look at the definition right here, it says that under 1 is the best because you get the best value for your buck. By that metric though, GameStop is overvalued based on Google. However, it still beats the book price to book ratio for Apple, because Apple is like 44, okay, when it should be close to 3. So, all right, and the same way with price to cash flow. Now, anything under 10 is good. Obviously, cash flow could be improved for next quarter. We'll see. But currently, it's overvalued for GameStop. However, look at the ratio for Apple. It's even more expensive. So if you compare Apple to GameStop, GameStop has a better ratio. PEG ratio, of course, we looked it up already. Anything under 1 is excellent. Anything over 2 is not. It's overvalued. Okay, let's move on. If you real quick looking at this particular financial position, anything above 1 is good because that means you have more asset than liability. With Apple, obviously, it's close to 1-to-1, which is not too bad. But a quick ratio is under 1 for Apple. For GameStop, obviously, anything above 1 is good. That's a good ratio to have right here. The same way with the debt to equity ratio, meaning that they have less debt than equity. If you have more than 1, that means you have more debt than its equity, shareholder equity. EBITDA, we didn't have that one, but for this one, it's less than 1. So what that tells me is that their debt is less than the earnings before tax and something. Sorry, just learned that one, but I forgot. Sorry about that. But anyway, since GameStop doesn't have the number, it's hard to compare it anyway. And so for this one, debt to cash flow, obviously it's over 2. That's concerning. We want it to be under 1, right? But again, cash flow could improve. We need to increase cash flow. For Apple, yes, close to 1. That's good. We want it to be under 1, but Apple beats GameStop on that one. Same way with interest coverage of 5.9. That's good. Anything over 3 is good for this one because you want more earnings before tax than the interest expense. For Apple, they have way more earnings, so that's good for them because they could pay off their debt 30 times better than, no, actually 6 times better than GameStop. That's what it means. But GameStop is still in a better, in a good financial position if you measure this particular metric. So there's no concern there, even though Apple beats it. Alright guys, that's all I have. So hopefully you understand where I come from with this analysis. This is why I don't get this forecast. Because again, by every metric or most metric, Apple is overvalued. Okay? Meantime, you have this one analyst in Wedbush, right? Obviously, it's at $6. That's crazy, right? So by that metric though, let's real quick, if you look at the metric there. So let's go look at the book value. Let's go look at the book value real quick. So this metric right here versus the other one. Hold on, give me a minute. Book, right? Price to book. That's insanity. So, all right. So by that metric, what I'm trying to point to you is that Apple is 11 times more expensive than GameStop. Let that sink in. Okay. All right. That's all I have for this one. Thank you for watching and have a great night.